Hello, everyone. My name is Robert April. I'm a Vice President at Provident Healthcare Partners and here to moderate our panel today of distinguished guests in the consolidation of urology examining transaction options. As part of our panel, I'd like to introduce Dr. Gary Kirsh, who served as the president of the Cincinnati-based urology group for over a decade. Dr. Kirsh was instrumental in the founding of LUGPA, a national trade organization representing independent urologists, and has been on the forefront of supporting independent urologists for over 30 years. His practice recently completed a partnership with the private equity group Lee Equity, alongside New York-based integrated medical professionals to create Solaris Health, the nation's largest physician-owned provider of urological services. Additionally, I'm pleased to introduce David Friedman, a principal at Gage Capital and co-leads the firm's healthcare vertical. With nearly 15 years of direct investment experience, David has sat on the board of 9 different portfolio companies, including a number within physician practice management, including ophthalmology, primary care, and most recently urology, through Gage Capital's formation of Urology America in conjunction with their partnership with Urology Austin. Prior to Gage Capital, David was a principal at Silver Oak Services Partners and a consultant at Bain & Company. My colleague, Kevin Palomaro, is also joining us, a managing director at Provident Healthcare Partners. During his nearly 2 decades with the firm, he has helped oversee a team of bankers that have represented over 65 physician practices through successful transactions. Kevin leads Provident's deal team that have represented the urology group through their transaction with Lee Equity and subsequent formation of Solaris Health. Throughout his career, Kevin has been instrumental in the creation of numerous platforms in the physician practice management space across nearly every physician specialty, including urology, ophthalmology, dermatology, and gastroenterology, to name a few. And last but not least, John Jones is a partner at Troutman Pepper and the chair of the firm's healthcare and transactions and regulatory practices. Through over 2 decades of mergers and acquisitions experience within healthcare across a wide range of subspecialties, including urology, John has earned a national reputation as one of the leading attorneys in physician practice management. John has worked on hundreds of healthcare deals and represented both physicians and private equity groups through successful transactions. And with that, we welcome all of you attendees here, and we'll kick things off right away. So the first question we have is, how will private equity help shape the future of the urology space?
Well, thank you very much for inviting me to the panel. Gary Kirsh here, and I know that this question has been directed at me. And I can state, with great affirmation and enthusiasm that private equity already has and will be shaping the future of urology, and particularly independent urology. And with that, I'd like to just make a few brief background comments and provide a rationale for this. I think most of you who are listening understand that the urology as a specialty has gone through several phases of its development. I've been in practice now for 31 years. When I went in practice in the late 80s, early 90s, I joined another physician in a 2-person group. As we went through the 90s and early 2000s, we saw a great loco-regional consolidation in independent urology, which led to the formation of LUGPA and the creation of so-called LUGPA groups. Now, as a result of that, there has been a great networking, a comparison of best practice, and an elevation of the specialty on the local and regional level. A natural evolution of this development and consolidation of the specialty is for like-minded groups to wish to come together to essentially create national practices. Now, and this is already occurring, as you heard in the introduction. Now, why would people want to do that? They would want to do it because we are facing increasing threats as independent practitioners. And we firmly believe that we need more scale in order to meet the regulatory threats and the threats to our revenues that are inevitably going to come down the line with value-based care and a host of other challenges. And finally, I would say that it's very important, at least in my opinion, to understand that private equity is a tool to help like-minded groups come together because they're tired of reinventing the wheel in each of their locations. It is still independent medicine. Critically, the difference between private equity-backed enterprises and hospital employed physicians is the fact that the folks who are partnered with private equity and with each other remain equity holders. And this is a concept that physicians need to get their arms around, that truly owning equity in your enterprise is the sine qua non of remaining independent. So I hope I didn't talk too long, but I think we're going to see a tremendous consolidation in the specialty, and we're going to see private equity dominate independent urology.
Yeah, the only thing I would add on there, and I think, Gary, you hit a lot of the same points I would have made, is that as the world continues to consolidate, it is just going to matter. Scale is going to matter as hospital systems consolidate, referral sources, suppliers. I also think, though, private equity firms are going to help drive growth, and the firms that are going to win long term are going to be the firms that are driving growth and growing faster than the market. Private equity today is very focused on how do you drive both organic and M&A growth, with a big focus on the organic growth, and that can come in a bunch of different flavors. So I think that's another way that private equity is going to impact this industry long term.
What are some key legal considerations prior to engaging in M&A process a practice should consider?
Good afternoon, everyone. This is John Jones from Troutman Pepper. There are a number of considerations that you have to take into effect when you enter a process, and it's not that complicated. Most of this is, visceral in some respect, and I applaud the doctors who have taken that leap to consolidate, whether it's been with a strategic or a private equity group. But the first question I start with whenever I meet with a group is, what does your group look like if you do not maintain the status quo? And that's the number one question. What are the competitive threats? I mean, Gary talked about threats generally, but what are these threats? Whether it be from the government, it could be reimbursement, it could be cost pressures, it could be your competitor down the street. But what does your company look like if you do not consolidate, if you do not grow, if you do not scale? And there is no right or wrong answer to your willingness to want to consolidate. It all depends on the culture and mission of the organization, which is another key factor. There is a window of opportunity in the last couple of years, and it still exists. I'm sitting here in December feeling much better than I felt in April from an M&A standpoint. I came into 2020 very bullish about M&A and the market, and I think we all did. I mean, 2019 was remarkable. I got to June and I'm thinking, okay, not so fast. What's going on here and where is this going? And now we're sitting here in December still talking about growth and consolidation. Every practice has to evaluate where they are today, where they want to be, and understand the key drivers. Capital doesn't cost so much today, right? We have accessible debt markets. We have very lucrative balance sheets. We have a lot of dry powder sitting on the sidelines, and that's just PE. I don't want to dismiss the strategics, because there may be a strategic consolidation play in the market, and you need to consider that. Other considerations on the legal side, getting to your culture and mission, is what do your shareholders think? What do they want? I think my first physician practice management deal was 17 years ago, if you can believe that, and it was private equity. And we had the same issues that exist today. We have 30-year-old shareholders, we have 40-year-old shareholders, we have 60-year-old shareholders. you need to manage those issues. And they're not just cultural, they are legal. And they will play out in the transaction and the documents. So one thing I would say is understand, as the leaders of your organization, what the organization wants. What are they driving towards? Also educate them on what the market looks like. And maybe you find a balance. The other piece is you really need to get your house in order. And we're going to talk a little bit about this later. From a legal standpoint, there are enough challenges down the road, whether it's, your EBITDA, your compensation, your rollback, your rollover. Those will be heavily negotiated in the deal. What you don't want is an organization that's disorganized. You want to go out to market having everything in order from a legal perspective, whether it's contracts, third-party arrangements, employment arrangements. Make sure that all of that is in order, just so you can check the box, because those should not be hurdles in a transaction. The only hurdles you should have is, what does the market look like? What do your financials look like? Do the organizational leaders fit with the buyer? And everything else should fall in place. And so that would be my advice to any physician group looking to enter the market and engage in a strategic transaction.
So in a similar vein of considerations by shareholders, what are the main considerations that a young, middle, and older physician at a practice should approach a private equity transaction with?
Well, thank you. I know that question is directed at me, and I'm happy to address it. I do want to follow up on one thing that John just said that I want to reemphasize because he had many pearls in his statement, and one I'd like to draw back out. When I speak to other companies about how to make a decision on where to go with your company in this environment, too often they are comparing what they believe is the status quo to some change, such as consolidation. But the fact is, as we all know, there's no such thing as the status quo in healthcare. Healthcare doesn't look anything like it did 10 years ago in my practice, or certainly not 20 years ago. So I just want to follow up on what John said and agree with him that it's not really viable to compare a 10-year plan where you have no change or a change, because everything's going to change. You have to just make your best bet and roll the dice. With respect to a transaction with young, middle-aged, and older physicians, this is often a critical element of the group dynamic. And I think, at least speaking for myself, and of course, everything I say today is my opinion and my opinion alone, I believe that private equity transactions have an erroneous perception amongst our community that somehow this is good for older doctors and not good for younger doctors. And I personally believe that nothing could be further from the truth. Frankly, if I'm involved in structuring a private equity transaction, I'm going to be certain that older doctors don't just get to take the money and run. They have to be in it for the long haul. With a transaction. And in fact, since older doctors sometimes do have retirement on the horizon, we need to know that up front. We need to factor that in. And to be candid, they probably won't benefit from the entire proceeds because they're just not going to be around to help build the company. And growth is the key, as was mentioned earlier. So they're just not going to be around. So they're not going to be there. This is not going to be a bailout for older doctors. It's not a golden parachute. On the converse, younger doctors traditionally think that this is some kind of thing that's going to harm them because they're foregoing income in exchange for proceeds, and they're going to be around the longest. Well, I can construct many arguments, both qualitative and quantitative, why this is the right move for younger doctors. On the qualitative level, as we've already touched upon, physicians today are looking at increased consolidation so that they don't have to reinvent the wheel, both clinically and from a business perspective in every region, city, so that they can achieve growth through the landmines that are coming from a regulatory perspective. So I think there's an attraction if you have a long career horizon to be part of a larger organization while retaining independence and equity in that organization. Furthermore, and I'll end with this, I can and have constructed quantitative arguments that would demonstrate with reasonable, what I consider to be reasonable assumptions, younger doctors actually can perform financially as well or even better under a private equity stock holding arrangement than they do under traditional practice. And physicians are typically not keyed into the concepts around equity appreciation, and that's what we really have to emphasize for younger docs. So I'll stop there. Thank you.
Yeah, and Gary, this is Kevin. I think that whether it's in urology or any of these other physician practice verticals that we focus on, that's really an important dynamic in any transaction, just dealing with those younger physicians, partnership track men and women versus the older docs. And I think there's also kind of, Gary, you know, and I think we saw this in our process, a balance that you need to make with those docs that you don't want to create a situation in which you're accelerating their potential retirement. So I think structuring the transaction with your private equity partner, thinking about those types of landmines and potential hurdles is critical. You know, making sure there's enough alignment with rollover equity, and in even some transactions, making sure there's some hooks in there to ensure we don't have a wave of early retirement or unexpected retirement within the group, because you know, these private equity folks are not buying hard assets. I mean, the assets are walking in and out of the practice or the ASC every day.
Yeah, Kevin, to follow up, I agree with you 100%. And of course, you and I have worked together. And I did not touch on partnership track physicians in my comments because, you know, time is limited. But I also think it's quite important to consider partnership track physicians, those who are not yet partners, and have them share in the wealth, so to speak, in order to create the proper culture around a transition towards this type of model.
Yeah, this is John. I'll chime in real quick. So Gary, you know, that's very common in all of these deals. If someone's close to partnership, these deals can be structured to take care of those individuals. One thing I always talk about to the young partners is it's less about the transaction and more about the competitive pressure. You know, a lot of these guys and gals are focused on their career with not much focus on the market. And I think you really need to just educate them on, glad you're pleased with your job, glad you're pleased with your cash flow and the money you're making, but look at the market, look at the competitive pressures. This is what we're facing in the next 5 years. What should we do about it? And then give them something in the rollover and the upside, but at the same time educating them on the downside, because it's usually significant in these markets, has been my experience.
One of the concepts we've hinted on a couple times here, but remains one of the largest complexity of a transaction, as well as one of the most important elements of a transaction, is the compensation scrape. It's something any physician hears about when they start discussing a transaction. How that compensation scrape is put together can vary fairly dramatically in these transactions. Would someone be able to answer how a practice should look at compensation scrape, what revenue streams are included, and how does this scrape vary by market and by specialty?
Yeah, sure, Robert, I'll take that question. And, you know, for those of you, I'm sure many of you that have joined the panel today in the audience are very well aware of what we mean by scrape, but just in general, when we say scrape, or in some cases you might hear the word remittance or rollback, you know, that is really the foregone compensation of the partnership physicians that creates EBITDA, which creates the value and the ultimate purchase price in the transaction. How do you get to that scrape and how is that determined? Typically, the revenue streams that are included would be a percentage of your ambulatory surgery center is acquired as part of that transaction. And in general, at least in the urology groups that we have worked with or reviewed, all of the ancillary streams are typically included in that compensation scrape. Generally, it's uniform across the board. So if your scrape is 20% or 30%, we're generally seeing that scrape level across the board of all the ancillaries. With that being said, I would say in certain instances, groups have taken the position that they'd like to see a variable scrape within some of the ancillaries. I would say that pharmacy and pathology, for instance, we've seen certain groups maybe want to have a lower scrape, in one of those ancillary streams. That's a little bit atypical, but it is something we have seen. It's seen practice in urology and in some other single specialty spaces. In terms of what that scrape should be, there's no uniform answer. This is not a compensation model that, maybe some of you private equity folks on the line have seen within dental practice management or ophthalmology, where you're doing a percentage of, professional collections. Generally, what we're doing here is you're kind of taking an overall group compensation rate and lowering that down to what I'll call, quote, market rate. And, what you really want to accomplish there is not really create a market rate where, you're putting them on par maybe with the health system in town. You generally want to put a little cushion in there so that you can kind of say, well, probably at 105% or 110% of where the average employed physician would be in that market. Getting to that number and into the right scrape can be, it's a little bit of a process, because urology is a little different. Urology is not a local healthcare practice. You guys know you have LUGPA, you have many big, large national groups throughout the country. You're competing for that. I mean, I'm just going to use the two groups on the phone right now. That man or woman who's looking to, join a urology practice could be talking to the folks in Austin, could be talking to the folks in Cincinnati, or even our friends in New York at IMP. So you're competing in that recruiting environment nationally. So you do want to balance that out and think about, okay, am I going to be competitive with my local health system when I develop this compensation scrape? And then am I going to be competitive with, the large practice 1 or 2 states over that's probably interviewing this individual as well? And as I said, there's no uniform scrape. Certainly the lower the scrape, I'm sure the more comfortable, folks like David and other private equity folks would be, because you're not going to have quite, quite the scrape and the compensation. And there's an ability and a path, hopefully, to get, some recovery in your compensation, or income repair, as it's called. But you could absolutely, as Robert said, in one market, a 20% scrape might make sense. But in a different market, there might be completely different demographics and dynamics where a much higher scrape can be warranted. So we've kind of seen it across the board, not only within urology, but within some of these other sectors, which are typically creating a scrape by way of remittance on compensation.
The only thing I'd add here.
Oh, go ahead, David.
Yeah, no, the only thing I'd add here is this compensation structure is great from setting alignment with the private equity firm and with the practice. So for us at Urology America, we don't try and come in with a preconceived notion of the scrape has to be X%. It's definitely a conversation between us and the partner, but then there's other things that come into play. The higher the scrape, the lower the scrape, as Kevin was alluding to, the better we may feel about it. So as the higher the scrape is going to be, we may ask for more rollover or things like that. So there's different levers to push or to pull to ensure that there's proper alignment between us and the partner that we're speaking to. So we don't try and come in with a one size fits all. It really is understanding. And it even goes to Gary's points earlier on dealing with older physicians versus younger partners versus physician track. All of these things have to be taken into account, and no practice is the same. No practice has the exact same distribution of physician shareholders. So we've at least found that being flexible on this front is important. But I would say, compared to what we've seen in other specialties, this compensation structure has everyone aligned on making the right investments, managing the business for long-term shareholder value instead of potentially having some misalignment there if it's just based off collections. I
couldn't say it any better from both of you. I really think it starts with education, has been my experience, because every doctor comes in with their own motives. Whether they're 40 years old, 50 or 60, they have their different motivations. And so it does require some education on what the transaction is. I think a lot of professionals, not just doctors, get very used to cash flow, and they spend it. What you need to do is reset these individuals into just their mentality. And you're no longer an employee, you're actually an owner, an investor in this organization going forward. And look at where you're going to get up front versus what you may or may not get over the next 5 or 10 years, given the competitive pressures. And so I think that discussion has to happen.
Our next topic here is around platforms versus joining established private equity-backed MSOs. So if someone could discuss the pros and cons of being a platform versus a regional add-on or add-on in a traditional sense, and again, what those pros and cons considerations should be for a group.
Sure. Thanks, Robert. I'll start off with this question. And this has applications across the full spectrum of physician practices, but we have a couple of groups on the phone. I'm sure they could follow up on this and kind of talk about their experience in developing a platform. Certainly a lot of groups in the urology space, and we'll talk about this later. There are a lot of large groups out there, and a lot of groups that absolutely could be platforms. And it's a little unique in urology. There's a lot of groups out there that are not just a large group of physicians. They actually have management and infrastructure, and I think are warranted to be potential platforms. So the pros and the cons of entering into a platform arrangement where you're the starting point. Obviously you think about things along the lines of greatest amount of autonomy. Certainly you are the starting point platform for a private equity group. You're coming in at $1 equity. So you have the greatest upside as long as you can execute with your new partner. You will absolutely have board representation, 1 or 2 seats on the board, along with your private equity sponsor, and probably one, third party who the private equity group will bring in that will add value and a voice to the table. You will actually have a hands-on role with the private equity sponsor in the development of the key legal documents, the governance documents, in terms of decision making, in terms of how do we handle good actors, bad actors, in terms of physicians. Those are the types of things that if you join a platform, we'll talk about this, generally are already going to be in place, and the group typically won't have a ton of flexibility on that. So you have a huge amount of say in the development of those types of things, the development of your recruiting strategy post-closing. The downside to all of that is it's going to take longer. I mean, I'll be completely honest. If you're a platform and you partner with a private equity group, because you are developing a lot of these things from scratch, it just takes a little bit more time. There's great law firms out there like John's, and they'll, help with all of this. And certainly we would, expect that the private equity partner you're going to go down the road with has done this before with other specialties. So that certainly can help. But there's other things you need to consider. I mean, those documents need to be formed and negotiated and agreed upon. You need to maybe recruit a management team. A lot of private equity folks, maybe Gage or others. I know Lee Equity certainly spent a lot of time interviewing candidates for kind of a national MSO. And again, the other con would be if you want to develop a new platform and you're entering urology, which is still in its early innings, you're going to have competition. You got 2 of them on the conference right now. But again, there's a lot of benefits to becoming a platform. A lot of groups want to be a platform. I think in terms of joining an existing group, we've got 2 of them on the phone on the Zoom meeting right now. The process should be extremely streamlined, I think, compared to a starting platform. They're going to have a lot of those documents outlined. They're going to have answers to some of your key concerns, like how do I recruit? I have 3 or 4 interviews next week. How do I handle those questions? A lot of those things they've already thought through. There could be best practices that get shared between the groups. As Gary mentioned, you guys are unique in the urology world. You have LUGPA, and you do a lot of these things as an industry already. So, you can collaborate, and there probably will likely be, minimal differences, hopefully, in terms of culture. There could be potential synergies, things that might be able to get centralized at a central business office. There might be some opportunities for income repair more immediately. Now, this would be very dependent as to geography. I'll just use Gary's group as an example. Potentially, if a group joined them in the Ohio market, just for example, maybe there's an opportunity with Anthem, maybe with the folks down in Austin with David, maybe there's an opportunity with United or Blue Cross Blue Shield of Texas, as you continue to build scale and potentially have more power, with the payers. If you join a platform, there is some downside potentially as well. You're probably not going to get board representation, but if you're a large group, you probably still will get board representation, and you will have a local governance board, whether or not you're a platform or not. You might be coming in a little bit later on in the investment, so maybe you're not getting $1 equity. Maybe you're coming in at $2. So maybe your quote upside in the overall rollover equity isn't quite where it would be if you were the starting platform, but it should still be significant if you're going to partner with someone. And again, maybe potentially a little less autonomy, but from a clinical day-to-day perspective, if you're a practicing physician, you're not involved in the management, like for instance, Gary is, you shouldn't see any changes, in your day-to-day practice of medicine. It should be seamless, whether or not you're a platform or if you're joining an existing group.
Kevin, I'll follow up on this question in the sense, I've gone through this a few times. And I think everything you said is absolutely correct. I want to perhaps put a little bit of a different spin on it. It's absolutely correct that that there's more work in creating a platform, but again, our specialty is no stranger to work. I think that there is, having gone through this and looked at the market extensively, I think that there is a little bit of a misconception about being a platform. Before you become a platform, it's one thing to partner with a private equity group and do a deal, but you have to ask yourself a few things. One, do we really have the infrastructure at our group with some private equity help to be successful over a long period of time? Or are we more likely to be successful if we partner and gather our forces with like-minded people? And the other thing that I think gets really left out is philosophy. There's a lot of PE firms and there's a lot of platforms, and some are represented on this call and there's others. And I'm not going to advocate for one versus another. But when we came to this business, we actually came to this business, myself and Dr. Kapoor at IMP, with a philosophy of what we're trying to achieve nationally. And that philosophy goes to the structure of the deal, and it goes to what we call life after the deal. How are we going to structure governance and so forth? So if you're going to be a platform, it's I think more than just saying I got a big group here and I'm going to beat my chest and be a platform. I think it's fine if you want to do that, but before you do that, think about your philosophy. Think about what your business goals are. Think about how you're going to differentiate in the market. Think about why you think you'll be successful as a platform. We did a lot of that and came to some conclusions that really shaped the type of company that we created.
So in a similar vein, then, how should a practice look at the number of private equity groups that exist out in the market? Because obviously there are a vast number that are evaluating urology as a potential investment opportunity. Are all private equity groups equal, and should practices look at them as kind of interchangeable? And how should a practice begin to evaluate these different options?
Yeah, I'll jump in here. Just like urologists, just like practices in general, not all private equity firms are created different, or are created the same. Private equity firms tend to be very different. Frankly, PE doesn't always have a great reputation, and some of that's well deserved, to be honest, right? And I think that goes to the approach that different firms take, and some of that is deserved. But there are a lot of good firms out there that are good partners and work well with physicians, care about making physicians' lives easier, care about continuing and improving patient care, making the investment to improve patient care, making the investment in new ASCs and new equipment, and hopefully working with the physicians as partners, can grow their business and create value and long-term value for everyone. So as folks think about partners and what they should be thinking about and evaluating against, I'll highlight a few items. First of all, it's just approach. So I can almost guarantee you every private equity firm that you talk to is going to say, we want to be good partners for you. And so what does that mean to them? And how do they articulate that and give examples of that? For a to gauge what that means is we want alignment. You heard me talk about that earlier, and that's really important for us. So for example, for us, one of our core tenets of investing is that we typically invest in founder-owned businesses. I think 16 out of our 17 investments have been founder-owned. And for us, we want material rollover from the, not just physician partners for any business that we're doing, but on average, our post-transaction, the founders own 40% of the business. So they're true partners to us. They don't own 10 or 15%. They own 35, 40, 45%. And we also think we can look them in the eye. Our senior team at Gage accounts for 20% of the capital. I think the industry average is closer to 3%. So when we say to a potential partner, hey, we want to make sure we're aligned, and because we think that creates the best partnership dynamic. And so we want you to own a significant amount. By the way, we own 20%. We just think that gets everyone aligned. I also think, how does the investment firm, how's the PE firm approach hitting their hurdles? Again, some of the reputation for private equity is probably well deserved. There are different approaches to being successful in private equity. Again, for Gage, we're very focused on growth. There are those out there that are very focused on efficiency, and that may be cost cutting, that may be just implementing Lean Six Sigma religiously. But for us, it's very focused on growth, and we want to be efficient and have good operations, but we're very focused on growth. And it's not just M&A growth for us. We want to make sure that there's an organic growth opportunity there. Another thing I'd recommend folks think about is just what is the private equity firm's experience with physician practice management? Healthcare is a very complex, difficult sector. I don't think as a physician partner, I would want to be putting my capital and investing that with someone who maybe hasn't had experience in the space before. I'm not sure I'd want to be the training wheels for them. And I'd ask them the results on those investments and how have they turned out for them. So I think that's really, really important. And then the last two things I'll quickly highlight. The other thing every private equity firm is going to say is, hey, we want to add value and we want to be value-added partners. So really push them on that, and how do they do that, and what does that mean to them? And then I would push for references. And just like in any job interview, if you ask for references, they're going to give you 2 or 3 references. And those are going to be cherry-picked and the best references they can provide. I'd ask for all of their portfolio company CEOs. And that way you get to choose which ones and have a chance to maybe talk to some folks where things didn't go that well. But I think that's really important too.
Yeah, I know. This is Kevin. I know Robert, from the Provident perspective, and Gary knows this as well. When we were going through that process, a group like Gage would be the type of group we would want to talk to, because if it's one thing to say, I did a DPM, or I did an urgent care deal, but I think we all know that's really not a good comparable. We really, need to be working with groups that have some angle or relevant history working with broader physician groups. Because, certainly a group like us, Gary, as when we got to those interviews and David, for instance, was at the table, we're going to have a whole series of questions for them. And if they're not prepared to answer some of those questions, can't tell us how we're going to recruit, how have you recruited in other instances where there's been a compensation scrape or a change, to the distribution formula that we currently had. Like you said, David, I think it's very well said. You don't want to be the guinea pig for somebody. You really do need to have, a private equity partner that's been down that road before, whether it's with a current holding, with a broad-based physician group, whether it's hospital-based or outpatient. Otherwise, I think there's a lot of risk. I won't lie.
So once a group has gotten to the point where they decide to run a process, what are some things that your practice should do from a legal perspective to prepare? And additionally, John, you mentioned earlier around regulation landmines. Can you expand on those and how they relate to prepping your practice for going through a process?
Absolutely. So when I first sit down with a group, I talk about, what does your practice look like? And typically I get overconfidence from a legal perspective and from an ops perspective. And that's human nature, right? That is human behavior. I love my company. We've done everything right. And this buyer is telling me we've done everything right. Look at this letter of intent. Not so fast. What I say is, if you really want that price, there are some things we need to do to get you to that price, because look at all the caveats in this letter, which no one seems to focus on. And one being, the quality of earnings. And so my first recommendation is, if you're going to market, get your advisors lined up. Get your investment banker, get your accountant, get your consultant, get your legal lined up, and really get the company ready for a sale. And the purpose of that is to maximize value. That's the number one thing here is, if you really want to go down this road, all of the shareholders want to maximize the value in the transaction. And so how you do that is you prep the company for a sale, both from a financial perspective and a legal perspective. There will be hiccups in any transaction. You don't want the little stuff to get in the way. And what I mean by that is, have your corporate records in order, have your contracts signed, right? Do that sell side due diligence that's required, because you don't want, whether it's a strategic or a P group, focused on those things. And I will give you the psychology behind it. You may say, it's no big deal, John. It's one signature down the line, right? With respect to each issue, it becomes a credibility issue. And so when we hit a hurdle like compliance or regulatory, you want them to give you the benefit of the doubt. And a lot of this becomes, in the realm of psychology. And so you're sitting down with them, Robert, and you say, okay, well, we have some of these hurdles. We need to be buttoned up from a compliance standpoint. Here's what we look like, especially with physician practice management. Here's how we deal with Stark. Here's how we've dealt with AKS, fee splitting in certain states that are challenging. And you want them to give you credibility in those conversations. So the better you look out of the gate, the better the process will go. There's another piece of this, though, and it's internal. It's not just outward facing to the buyer, but it's really preparing your company for a sale, the ops people, the shareholders, and educating them on what the options are and what it looks like, and timeline and hurdles. I haven't met a PPM deal I couldn't close, but I can't tell you I can close them in 3 months. And we all know that. So you have to level set expectations that some deals just take longer. And it may be 3 months, it may be 6, it may be 9, it may be a year and a half to get this thing done. It's helpful to do that up front, because it avoids challenges down the road when you need a vote depending on how the shareholders agreement is written. And you expect everyone to come along and they're not frustrated by how long the deal has taken, or if they've gotten deal fatigue. So you want to manage those issues as well. Most importantly, I think through all of this is really shareholder communication, because as much authority and power that the leadership has from a legal standpoint and what the documents reflect, your buyer will want the supermajority, if not everyone, to be on board with the transaction. And so it's critical to maintain that communication and education and to keep them on board throughout the process.
So one of the common questions that I get when speaking with physician groups, particularly in urology around the country, around heartburn around private equity, is the concern of, well, how can a private equity group come in and grow my business better than I can as a urologist? And so, what are the primary ways that a private equity group would look to help a group of physicians in urology grow their practice? And how is that different than they would be able to do themselves, without a partner coming in?
Yeah, so I'll jump in here. And I think it's a few things. I'll try and touch on a couple of things. First of all, a lot of the strategies are similar. In fact, frankly, the physicians know their business best, right? We're never going to know their business as well as they do. So a lot of times the best ideas we have on growth come from our physician partners. But we're going to focus typically on organic and M&A growth. On the organic side, we're going to look around and understand the ancillary service lines that are currently offered and the opportunities to add additional ancillary services. And there's really a matrix of understanding how easy is something to implement and how impactful is something to implement, because something may be extremely impactful and profitable, but there are all sorts of barriers to doing it. And so maybe that's not something we want to prioritize. And at the other end, something may be very easy to implement, but if the impact isn't really worth it, then it's probably not worth putting on our list either. I mentioned this earlier. A big thing for us is investing to help the providers give better care. And so a lot of times we'll come into investments, we'll look to add ASCs that are purpose built for the specialty, that have the specialized equipment, rather than doing it in a multi-specialty ASC. It's an ASC that is just for the practice, just for urology or ophthalmology, whatever the case may be. We put a big emphasis on increasing providers and new docs, and also adding APPs to allow the physicians to practice at the top of their license and be as efficient as possible. We think we have a lot of great experience and can help on the marketing and patient acquisition strategies. And then also leveraging some of our broader relationships on payer contracting, and also potentially looking, if you have enough density in a market, at capitation contracts or other value-based care approaches. And then M&A is obviously something that's in our wheelhouse, and probably something that is new or not something that most physician practices have done a lot of. And when you think about what if any of those things are things that we couldn't do on our own, like I said, I'm not sure that our approach and our strategy is all that different than maybe what the physician groups might come up with on their own. I do think the discipline and the execution may be different. We've looked at plenty of businesses in urology and other specialties and said, all right, well, you made that capital investment, like, what's the payback on that? And, you get blank stares. What's the ROI analysis on that? And no one thought about that. Well, where does this fall in the 2x2 of easy to implement and impactful? And so I think the discipline that private equity can bring is important. I think the speed and the pace that we're able to push and move is important. Bringing accountability to the organization, I think that's important. And those are just different things than physicians that are full-time practicing physicians focused on patients. It's just tough to focus on all those things simultaneously. So for us, our goal, if we do it right, is, we want to make the physician's life easier. We want to help them grow their business, and do those two things simultaneously. So that's how we think about it. That's how we believe it's a little bit different than going it alone. And coming back to some of the questions from earlier on the difference between being a platform and joining an existing platform, all those things I just said also go to, once you join with an existing platform, assuming you choose the right partner and they've been successful and you can see that, your execution risk on all of these things is less. If they've implemented an ancillary service that you haven't, you can take that best practice. And by the way, if you have the right partner, they'd also want to see your best practices and take it to their practice. So I think there's a lot of execution risk that gets reduced by joining an existing practice.
If I could comment briefly, I think David did a great job on that question. I don't want to repeat what he said, but I just want to focus on one aspect of it, and that is the notion of growth itself. Businesses that aren't growing are businesses that are not succeeding. Our costs go up every year, and too many times in physician practices, doctors may take the approach, oh, well, we didn't have such a good year this year, but really looking at that approach, it can be quite a downward spiral. So just having the discipline, as David said, to have a business partner affiliated with the physician group to focus the attention on the need for growth to create a sustainable business is something that's very valuable for physician groups, aside from all of the specific strategies that David mentioned.
So we've obviously talked a lot about transactions and considerations when approaching a transaction, but when we actually think structurally, what do transactions look like, and what are the key legal issues that the physicians need to consider when actually structuring a transaction alongside counsel? What are those things? What are those headlines that a physician should think about during this process?
Yeah, so it all depends on who the buyer is. Is the buyer a strategic or is it private equity? And those who have been through the process have experienced this. I've got 5 or 7 LOIs and they're very different. And they're different because of the point of view of the buyer. And so the first question is, where do you want to be? Do you want to be on the private equity side? Do you want to be on the strategic side? You then have to ask the question, what is governance going to look like? My experience with physicians is they are very concerned with their day-to-day and clinical aspects of the practice, and they like their autonomy. I put that completely separate from the administrative world of doctor practices. And it's actually a nice fit oftentimes with private equity because they want to kind of manage the admin piece and allow the docs the autonomy to do the clinical piece and have their day-to-day and not impose too many rules and regulations over what time they get to work. Are they punching the clock? This is something that the docs have to get used to because they have a written employment agreement that they take very seriously. And this has been somewhat of an education. If it says 15 personal days, it says 15 personal days. If it says you have to go 8 to 5, it says 8 to 5. The PE groups usually say, well, we want that, but we may not actually mean it, right? And we've all experienced that. They're focused on productivity and they need some kind of at least structure to the operations. Those can be some hurdles in the entire transaction process. If I'm a doc and I'm entering into the sale transaction, I really want to understand my employment agreement, my non-compete. And we need to separate the non-compete in the purchase agreement from the employment agreement. Two different things, and not always consistent. And different enforceability standards depending on which state you're in. And so that's why you have to have your advisors around you. Be ready to be educated on rollback, which is a compensation concept, rollover, which is an investment concept, straw man structure, which is a fiction we've created to deal with corporate practice of medicine. And that's why, I've said it a few times, it really requires education. These are all new concepts to physician groups. I'm waiting for the day that we could sell law firms to private equity, and looking forward to getting cap gains on my compensation. Right? And that's just my opinion. But it is a new world for them. Luckily, for those who are entering now in urology, and I did my first urology deal, I think it's been 2 or 3 years, did one of the first ones in the marketplace. But you can talk to your colleagues about what it looks like and what they've experienced. It's probably not a bad idea, but I do think this is the future because it's less about, what drives you to be a practitioner and more about surviving and competing in today's world.
So in that same vein, then you mentioned, you did one of the earliest transactions a couple of years ago in urology. Where do we think that we are in the life cycle of urology and consolidation? And is that the early innings? Are we midway through? Where do we feel like we are in that consolidation?
Kevin, in some ways I'll defer to you, but I would say from our standpoint, if you compare urology to the other specialties, ophthalmology, dermatology, et cetera, feels early innings. I don't know that we end up with 36 urology private equity-backed platforms. In fact, I'd bet against that. But right now there's a handful, and I doubt it stays that way.
Yeah, I think there's some comparisons to be made here. And Robert, I think this kind of ties into the next question, so we'll just kind of combine our thoughts here. But we're in the very early stages. I think very similar, to ophthalmology. The first transaction in that space, we worked on that deal. And then the next wave, it took about 1.5 years, 2 years. And Chesapeake happened with Audax. Audax tends to be a first mover in a lot of these different verticals. And, it's just taking some time for the next wave. But I think this is the next wave. I think with urology, what you're going to see, you're not going to see ophthalmology. There's not going to be 500, urology platforms or whatever we have in ophthalmology right now. It's getting a little out of hand. But there will certainly be comparables, I think, to gastro. I think orthopedics will probably fall into the same vein, where we'll probably have maybe 10 really good platforms. I would say, we talked about it earlier, you have LUGPA, and there's a lot of big groups out there. So there's going to be plenty of opportunities for groups that probably can do, a scrape and have 5 to 10 million of EBITDA to develop their own platform. But I think, as Gary and David had mentioned, not all of those groups are going to be platforms. They might be better served to be a regional hub for David's group, or a regional hub, for Gary's group. But there's definitely the size and scale of groups out there. There's some very, very large players. I think we're in the very early innings. I think that, I'm guessing, Audax and their Chesapeake guys are probably in the late innings, and that'll probably be your first example of somebody coming in and coming out the other side. And we'll talk about the second bite. But most of the other groups are kind of in the same boat, with David and Gary. First year of the investment, probably not looking to do anything unless something really crazy comes across your desk, for the next, 2 to 4 years. So very, very early stages of kind of consolidation, like we've seen with some other areas, kind of probably around in the same ballpark as kind of orthopedics right now. Still very early stages, still a little ways out from kind of the second bite.
Yeah, I've sort of been waiting for this to take off. I think we're way in the early innings. The Audax Chesapeake deal that we did, uh, I'm not sure Audax was ready for it, quite honestly. It's something I, presented to them, and I think they liked the organization and the company, and they like physician practice management. But I'm not so sure anyone at that time had their sights on urology. And so completely agree that this is way early.
Yeah, and I would tell you, just as a follow-up, just there's probably private equity folks on this call. There probably are some, urologists on this call. There is definitely now a developed thesis in the market. There are some very high caliber private equity groups that have said we are going to find a urology platform to acquire. So again, I'm fairly confident by the time we get into the middle of 2021, you're going to see probably 8 to 10, really good platforms out there. Within the urology market.
So one of the biggest drivers of growth currently with practices prior to doing a transaction is recruiting new physicians and continuing to grow the number of heads, in their current house. How can a practice continue to be successful recruiting new physicians when they've gone and sold a meaningful portion of their equity and of their compensation? How can you still create that compelling package where you are able to compete with groups that haven't done a deal, or the hospital system, or other?
Thank you. I'll take that question. And I would say that it's really not how can you, that frankly, you must solve that problem. And if there's one question that I get asked more than any other, legal structure, scrape, growth, second bite, it's a question of, are we going to be able to recruit? Because every physician understands that recruiting is the lifeblood of their company, because without recruiting, not only will there be no revenues, but perhaps even more importantly to some doctors, there'll be nobody to share call with. And the worst thing that can happen to a doctor, which is not being discussed in this forum, is to go from every fifth night to every third night on call or something like that. So recruiting it has to happen. Now, can it happen? Yes. Will it happen? Yes. Now, speaking for myself, and this may not be universally agreed with, I think that there are some differences between urology as a specialty and some other specialties where we've seen a lot of PE activity, such as derm and so forth. In urology, we don't tend to have a culture of one doctor owning a practice, or a small group of doctors owning a practice with a bunch of other employed physicians. That's perhaps true in anesthesia or derm or other specialties. It's not been the culture in independent urology at all. It's been an entrepreneurial specialty. And just as an aside, I'm going to come back real quickly to something that John said that I think, to be candid, we have to be careful of. And that's assuming that these large practices that really have developed significant infrastructure and the physicians therein are only interested in the clinical side. In fact, they're also interested in the administrative side because they've been doing that for a long time. So we have to create transaction structures that create a balance between the local group and the MSO. But that was a bit of an aside. With respect to recruiting, we have to, in my opinion, create a model, because of the culture of our specialty, again, entrepreneurial and a lot of hands-on by the docs and not owned by a small group. The new recruits have to have equity. And I don't know if everybody on this panel or on other PE viewers agree with that, but that, in my opinion, is fundamental. And we have created a model, which is no secret. Anybody can create it. We're not geniuses. It's a philosophy where new recruits will be granted the opportunity to either purchase equity or achieve profits interests in the new enterprise. We simply do not believe philosophically in recruiting without equity, and we have constructed a financial package, frankly, that with, again, what I believe are quite defensible and reasonable assumptions that we can put directly in front of new recruits and have put in front of new recruits, and very convincingly argue to them that they're going to be very financially successful, more so than the hospital, and perhaps even more so than traditional independent practice, by coming into our platform.
So our last prepared question here of the program centers around really, what does this all mean for a group in the end? And what does that outcome look like, or that second bite that you hear about? Once you've partnered with a private equity group, what then? You grow, you hopefully have a successful partnership, but what does the culmination of that partnership look like?
Great. So I'll start with this one, and certainly, David, you had plenty of experience at Gage, coming in and having, great outcomes with your portfolio companies, but for the men and women that are rolling over equity in these transactions, and it is meaningful, the expectation should be 30, 40+% rollover. The expectation is that your new private equity partner is going to hopefully, do everything they said they would do. And 3 to 5 years from now, you'll be in a situation in which that rollover equity is appreciated, and you'll get a return on that invested capital anywhere along the lines of 2.5 to 4, times, what you put in initially. And that's why you want to roll that equity in. So if you're a shareholder, I would also tell you, you're probably going to be asked, probably not required, but probably asked very, nicely on that second bite to reinvest, with the next private equity group, assuming that the next bite is to a larger private equity group. Because again, urologists are high producing physicians. It's going to be critical to create alignment. And I don't think there's anybody quite, to the scale, and probably not even at the next bite, where they're going to be large enough and diversified enough where you wouldn't want to still have a required rollover amount, for those physicians. So your expectations as a physician should be, on a second bite, you'll have a very healthy return on that reinvested capital, that rollover, or that John had referenced. And your expectation should be that you'll likely have to, reinvest a portion of that back in to the next transaction to create the same type of alignment. What those buyers are going to look like, it's going to be somewhat similar. I think that, as Gage and Lee Equity kind of look down the road, they are establishing, platforms now. So the next partner, it might be a private equity group that has limited physician practice experience, but it might be one of those massive, $5 to $10 billion funds that is, you're more comfortable with them doing the deal at that point, because you have a well-oiled machine. They're just investing in the opportunity, because it's opportunistic, and they have, this great, C-suite of leaders, and it kind of runs on its own. And so you don't have the concerns you have when you're interviewing a Gage or a Lee Equity, when you're talking about founder-led businesses. I think as you also think about the ultimate exit, Robert, one thing you and I know is that we have seen an increased activity from strategic buyers. I think that we have seen in our processes, groups like SCA, like Surgery Partners, Covenant, some of the ASC management companies are showing quite a bit of interest, not only in the ASC side of these practices, but in the practice itself. So, those are large groups, and I think that it would not surprise me down the road to start seeing, more public or large non-private equity consolidators enter the fray within urology. And then, I think, as a real outside the box potential down the road, I think you should also think about another vertical that has gone through significant private equity expansion, and that's women's healthcare. I know that there are some overlapping thoughts from certain private equity firms out there about potentially down the road bringing those types of practices together in more of a multi-site, multi-specialty model. So those were probably more down the road. Those are the types of things we'll probably be seeing here in the next 2 to 4 years for urology, as some of the gauges and the Lee equities of the world consider their next step.
So with that, that does conclude our program here today. I want to thank David, Gary, Kevin, and John for joining us and offering their insights on these topics. This recording will be sent out to all those that registered for our webinar. So you should, in the coming week or weeks, get a copy of the recording here. Will also be found on YouTube and a number of channels. If you do have additional questions that we didn't cover today, please feel free to reach out to any of us, and we'll be happy to expand on any topics you would find helpful. And so with that, I'd like to thank everyone for joining us, thank our panelists, and everyone have a nice day.
Thank you very much.